Good afternoon, everyone. Anthony Iser from ITPM with another ITPM Flash. Well, what a weird day it's been in Washington. We've had Mitch McConnell almost die live on TV, only to be wheeled out again weekend at Bernie style later in the day to keep talking, seeming somewhat alive, but very much worse for wear. We've had presenters in Congress swearing on under oath that aliens have visited us and we have alien bodies and aircraft hidden away in hangars. And the third part of all this weirdness that we saw today was Jerome Powell virtually uttering the phrase, "This time it's different." Now, every amateur trader at some point in their career has probably said, "This time it's different," whether it's in reference to the tech bubble, AI, or whatever thing that they're talking about at that point in time. But we work through cycles, we realize it's never really different. Things might rhyme, they don't necessarily repeat exactly the same, but rarely are they too different. And so far in history, every time the Fed has raised rates like this, it's caused a recession. Powell thinks this time it's going to be different and there's going to be a soft landing. Only time will tell. But what I want to focus on is what happens in markets around these times. What's the outlook? What are the opportunities? If you have a look at this chart here, you'll see that historically, from the time we've had the first rate rise through to when a recession happens, is about 18 months through to 2 years, 3 years. We're currently at 15 months. You can see the arrow there. So the likelihood of having a recession so far, despite some very negative economic data flowing through, has been pretty small. But as we move through this next 18 months or so, it's highly likely that we'll have one. And historically, that means at this point in time, around Fed pause, markets tend to be strong. It's only as we move to rate cutting or the Fed pivot that markets tend to dramatically underperform. But will that happen? I don't know. We'll cross that bridge when we come to it. So what can we do now in these markets where the economy is pretty mixed? Well, firstly, I want to draw your attention to this chart. Housing market has been pretty weak on most metrics, yet building construction companies are up to all-time highs, 52-week highs in recent trading, and performing incredibly well. Why is that? Well, normally at this point in a cycle, we see prices down, we see demand down, and we see volumes down, impacting earnings and share prices down. This time, there's one big major factor that's changed. Supply is massively down. This chart here shows existing home sales. Inventory is down massively, 75% since the big peak before the financial crisis, but down 30% year on year as well. That has led to a supply-demand dynamic that is very much in favor of construction companies, hence their strength. So the question I'm asking myself is, will this continue? And there's no reason to see in the short term why it won't. What's going to change that supply-demand dynamic? New constructions coming on stream, but not at aggressive levels, so that's not going to drive supply. Interest rates look like they're going to be higher for longer, so we're not going to see them come down. 70% of people have mortgages that are under 4%, so there's no real incentive to see a lot of new supply come onto the market, unless we see something like unemployment rising and forced sales, and that's that hard landing scenario. That's probably a little way off. So at this point in time, it looks to be a little bit of a Goldilocks period for construction companies. However, I'm turning my eye to building construction materials companies that haven't run quite so fast. If you have a look at this one here, this is James Hardie. It's an Australian company, but very much focused on the US. The bulk of their revenues come from US housing market, and they make predominantly cladding that goes on the outside of buildings. And things are going reasonably well. Like a lot of construction, numbers down slightly in this past year. But we've got growth numbers coming through of 7%, 10% on the top line and double-digit EPS growth. It's a premium name in the sector, trading at a multiple of 22 times next year's earnings. And I think there's room for upgrades here. As pricing remains steady, starts to pick up a little bit as that supply continues to be very much at record lows, and demand is holding in there. So we're going to get volumes coming through, we're going to get pricing coming through, and a continued re-rating for this company, I think, over the next little while. So I'm having a look at James Hardie, trying to look around the result, August 8th, a couple of weeks away, structuring my idea around that. Now, of course, the consumer is under pressure. This factor for housing is quite specific. The retail sales are under enormous pressure, particularly same-store sales, as this chart here shows. The weekly, year-on-year growth in same-store sales isn't growth any longer. It's negative. And if we strip out the period that happened around COVID when the whole world shut down, you haven't had negative numbers since the GFC. So these are very, very weak headline numbers for same-store sales growth. Now, of course, companies can open new stores, they can expand overseas, they can get sales growing that way. But I'm inclined to look at a company that doesn't have those opportunities. And if anything, they'd be more inclined to be closing stores. And that's the department store sector, and particularly looking at Burlington stores. Now, currently, they do have pretty strong growth forecast, but I'm suspecting that that is going to come under severe pressure over the next 3 to 12 months or so. So looking through to the result, August 24th, I think we're going to start to see some significant downgrades coming through. Pricing pressure across the board, inventory's been building, whether it's been Target or Walmart or specialty stores. Nike's had those issues as well. There's no reason why Burlington won't. So 2 consumer-exposed stocks, one I'm looking to be long, one I'm looking to be short. And that's the type of stock-specific things that I think everyone should be looking for in a market like this, where we're at that pause point of the Fed hiking cycle, likely to be some continued strength in markets, the volatility around the underlying economic numbers. So that's my focus today. It's been a very weird day in Washington, but opportunities are still out there for us. Enjoy your day, enjoy the weekend. I'll talk to you again soon.